Hi, my name is Darren Joseph from HTJ.tax. We're the team that seeks to demystify this sometimes confusing world of international tax and the privilege of having a deep conversation with Mark. Mark, can you please introduce yourself?
I'm Mark Morris. I'm based in Switzerland. I've been here for about 26 years. I've specialized in automatic exchange of information, which originally was the EU Commission's EU Savings Tax Directive. And that went on until about 2014, and they scrapped that and they adopted the OECD's FATCA made into CRS.
So can you share with us what it is you do professionally?
Primarily, I provide custodial services for trusts to hold underlying entities or partnerships or unincorporated funds. So what I do is I provide the administration services for the custodial. I don't do the actual custody. And later on, I'll explain what administration services for custodial is. And I'm an expert in CRS and CARF, and I certainly know the intricate differences between CARF and CRS. We'll get into that in a later question, okay? I've published over 600 articles on LinkedIn, and I'm still writing about 10 a week. And I don't see other people covering 99% of the topics on CRS that I cover.
Okay, thank you. Let's touch on equity interest trusts. What is an equity interest?
This is really not well understood by the industry, okay? So equity interest and debt interest. So if you're a trust and you lend, they're often distributed via loan. Here's a loan, pay us back on the never, never. That's debt interest. So for trust must report the financial accounts of those that hold equity interest and debt interest. However, if that equity interest is an entity, do you look through that entity, even if that entity is itself a financial institution? So the State Secretariat of International Finance in Switzerland came out with a CRS update recently saying, we read in the implementation handbook that equity interest is an entity. It doesn't explain what type of entity. You must look through that, whether it's a financial institution or not. And they specifically said there's no blocker anymore. You must report through that. But equity interest only applies to investment entities. I only realized recently, I thought equity interest relates to other types of finance. Unless there's an anti-avoidance clause where they say equity interest is interests that are set up to avoid reporting. But that's subjective again. Who's to determine that? So why I say the state secretary is wrong is a couple of reasons. Number one, the implementation handbook doesn't replace anything that's in the CRS or the CRS guidelines. It's supposed to make it easier. And if there's a conflict, then ignore the implementation handbook. But the main reason for ignoring the implementation handbook is if CRS says, and it's 5 times they say that, if a custodial institution holds the equity interest in a trust, then it's not up to the trust to report. It's the custodial institution to report. And they give examples and so on. And yet, State Secretariat said, doesn't matter, look through that. Total conflict with the CRS. So Hong Kong came out and said in their CRS guidance, we assume that the implementation handbook is talking about reportable entities, not just any entities. Okay, so I've looked at a few other CRS guidelines. They kind of quiet on this, but they do say that a financial institution is a non-reportable person, generally. So they shouldn't be looking through that. But this aspect of what is the equity interest and debt interest is confusing to people.
So let's assume that, of course, the Swiss didn't make a mistake. Why do you think that they're adopting such a position?
I have no idea, because they said this is a blocker. I think this is an anti-avoidance issue on their side, because they wouldn't use the word no more is a financial institution a blocker. But the core principle, when you spoke about what is CRS, if there's a chain of FIs, financial institutions, okay, and eventually one is with a bank or something like that, it's not up to the bottom levels of the FIs to report. It's up to the top. Why is that the case? Because they didn't want duplicate reporting. So if the FI above you, the parent, is going to report, then you don't report. And if they've got an FI, then they don't. It's the top level FI that's supposed to report.
Right.
But here they just say, look through. And another reason why I say that's wrong, they said look through any entity. Now, an entity can be a non-reportable person, such as a central bank, an international organization, a government entity. And so they're saying, look through those. You see how clear it is that they're wrong. Okay,
Mm.
because
So
those are
then
not
ultimately, no one will report.
well, they say look through Swiss. But if it is a non-reportable person, it could be a type of a pension fund that's non-reportable, then there's no
Right.
reporting.
Okay.
But they
Understood.
say look through any entity. So I take my hat off to the Hong Kong that said we assume there was a mistake in the implementation
Right.
handbook, and they meant to say non-reportable entities that own equity interest. It's only report on reportable entities.
Right. Okay.